Welcome. This is the third and final lesson that we'll use to walk through the financial statements. In this lesson, we're going to take a detailed look at the statement of cash flows. Then we'll go back and revisit the other three financial statements and look at how all four of the financial statements work together. Before we get started, please take a look at the other financial statements that we reviewed in the first three files. You may want to pause the video to do that. The first section of the cash flow statement that we'll talk about is the operating cash flows section. There are two methods we use to prepare this section. We can use the indirect method, which starts with net income and makes adjustments for non-cash items or adjustments to move from accrual accounting to cash accounting, and then comes to operating cash flow. Or we can use the direct method, which simply shows all of the cash flows for the operating or central operations of the company. So cash paid to suppliers or cash received from customers. The most common method used is the indirect method. So that's where we're going to spend our time in this lesson. We will, however, give you an example of the direct method so you can see what it looks like. The second section of the cash flow statement is the investing section. This section takes a look at the long-term type assets of the company and the cash flows from those assets. So did the company spend money on property, plant, and equipment during the year? Did they sell some? Did the company spend money on investments in other entities? Did they sell some of those? Those are the types of things that we'll see in the investing section. Finally, we have the financing section. This is the area where we get to see what the company did to finance their operations. Did they borrow money? Did they sell stock? Did they pay dividends to their stockholders? Once we've looked at all three sections, we can add them together to give us the total change in cash for the period. We then combine that total change in cash with the beginning cash balance as of the year, beginning of the year, and the two of those together give us the ending cash balance for the year. Both of those numbers, the beginning and ending cash balances, will show up on our balance sheet. So let's take a moment to revisit ABC Company and look at their cash flow statement. Before we begin, let's look at some additional information we're going to need. First, we need to know that the administrative expenses in the income statement include $50,000 of depreciation expense. Second, we need to know that property, plant, and equipment of $60,000 was purchased with cash during the year. And finally, we need to know that available for sale securities of $32,000 were purchased during the year. Take a moment to write those down, as we will revisit that information as we go through the cash flow statement. And if you haven't already, make sure that you have available to you the income statement and the balance sheet and the statement of changes in equity for ABC Company. Now that we've gathered everything we need to look at the cash flow statement, let's take a look at ABC. Notice the first thing that we see here is net income. That's our cue that this financial statement was prepared using the indirect method. Remember, that method starts with net income and then makes adjustments to go from accrual accounting for net income to cash basis accounting for the cash flow from operations. The next thing we see is the adjustments for the non-cash expenses in income. In this case, we happen to have a gain and a loss on the sale of non-current assets. Both of those are non-cash items in the sense that we did receive some cash for the sale, but the gain and the loss doesn't represent the cash figure. It just represents the impact on income. In addition to that, both of these items, the equipment and the securities, are investing type activities. So we want to remove anything related to those from the operating section of the cash flow statement. We'll revisit that when we get to the investing section. Finally, we see this depreciation expense. Remember, property, plant, and equipment is paid for at the beginning of its life. That's when we see the cash flow. Throughout its life, it's going to be depreciated and expensed on the income statement. Those expenses represent non-cash items, So we need to remove them from net income in order to get to cash flow from operations. The last set of adjustments we'll see come from the balance sheet. These are the changes in the operating assets and liabilities of the company that represent accrual accounting. If we make a sale on account, accounts receivable goes up, but the company didn't receive any cash. Because of that, we need to make adjustments for the changes in the operating assets and liabilities. Take a look at the balance sheet for ABC. See if you can see the change from beginning of year to end of year in each of these operating assets and liabilities, and reconcile back to the numbers that we see here. Now that we've looked at the indirect method of the cash flow statement, let's take a moment to look at the direct method before we move on to the investing section of the cash flow statement. Notice that we don't begin with net income here. Instead, we just show all of the cash outs and ins that the company had related to the operations. We can see that we show cash received from customers, as well as various cash payments made for things like supplies, wages, administrative expenses. And then down below here, we see cash received from dividends and cash paid for interest and taxes. This is a level of detail that we didn't get in the indirect method. Because of that, there are a couple of things here that are actually required to be disclosed as supplemental information if we use the indirect method. Specifically, a company is required to show cash paid for interest and cash paid for taxes as a footnote disclosure to the cash flow statement when the indirect method is used. Now let's turn our attention to the investing section. Notice that the first number we see here is the purchase of property, plant, and equipment for $60,000. That was part of the additional information that we gave you at the beginning of this lesson. The second number we see is the amount received from the sale of property, plant, and equipment. Let's try to see if we can reconcile how that number was calculated. We're going to look at the property, plant, and equipment T account on a net basis. So that means this account includes not just the cost of the property, plant, and equipment, but also the accumulated depreciation as well. If you look at your balance sheet, you'll see that the beginning balance in this account was $480,000. The ending balance is $450,000. We know that during the year the company purchased an additional $60,000 worth of equipment. That was given to us in the beginning information. We also know that $50,000 of depreciation occurred during the year. So given that this is the information we know, we can now back into an amount here necessary to balance the account. That's $40,000. That represents the book value of anything that was sold during the year. So if the company sold items with a book value of $40,000, how do we then have $80,000 as cash received from the sale of property, plant, and equipment? Well, if you look at your income statement, you'll see that when the property, plant, and equipment was sold, they actually had a gain on the sale. The gain was $40,000. So if the company sold something with a book value of 40 with a gain of 40, that must mean they received $80,000 on the sale. Now let's look at the last two pieces of the investing section. Again, we see that the company made some purchases of available for sale securities during the year. That was part of the given information as of the beginning of this lesson. We also see that there was a sale during the year. Let's see if we can reconcile to that figure. So we're going to look at the available for sale securities account, and again go to the balance sheet to see if we can see what the beginning and ending balances were, then reconcile the middle. So we can see that the beginning balance was $90,000 and the ending balance was $67,000. We know that purchases were made during the year of $32,000. because that information was given to us. Now we can see that there must have been something that happened during the year to cause us to go from these amounts to our final of 67. If you look at the balance sheet, you'll see that in the equity section, there is an accumulated other comprehensive income figure. And you'll see that it's changed during the period. It's gone from 7,000 down to 2,000. That means that available for sale securities lost value during the year. So we'll put $5,000 change in value for the available for sale securities. The final change then can be reconciled again to $50,000. So we know that securities with a book value of $50,000 were sold during the year. If we then look at the income statement, we'll see that there was actually a loss on that sale. The loss was $10,000. So if we sell something with a book value of 50 for a loss of 10, that must mean the company received $40,000 in cash. And that's what we see here with the sale of securities. Now all we need to do is sum all of the pieces to get to our total cash flow from investing activities of $28,000. The last section in the cash flow statement is the financing section. Let's look at ABC Company here. We can see that they've had two financing cash flows during the period. The first, they had an issuance of common shares during the year, and the second, they had a repurchase of shares during the year. The place that we can go to find this information is actually the statement of changes in equity. If you look at the statement that's in front of you, you'll see that there was a line item for the issuance of common shares during the period. You'll see that that amount shows up in three places. You have the increase to the par value of $10,000. You have an increase to the additional paid-in capital of $35,000. And the two numbers together in the far right column equal the total amount of cash received of $45,000. The second line, this repurchase of treasury stock, can also be seen on the statement of changes in equity. If you look at the line for repurchase and go over to the column for treasury stock, you'll see that treasury stock of $5,000 was repurchased during the year. That gives us a total cash flow from financing activities of $40,000. Now we're ready to put it all together and see what the cash flow statement would look like. We've removed the operating section detail here for space, but remember that there's two approaches to that method. We could either use the indirect method or the direct method to come to the total cash flows from operating activities. Then we see here the investing activities section and the financing activities section, all three of which come together for our total increase in cash during the period of $70,000. We combine that with our beginning cash balance, which you can see on your balance sheet, of $30,000 to give us our final total for ending cash of $100,000. Now that we've seen the full financial statement, remember that if this was prepared using the indirect method for the operating section, we'd have to give that supplemental disclosure for cash paid for interest and taxes. All right, now that we've reviewed the cash flow statement, we've finished our review of all four of the financial statements. It's now time to step back and take a look at how they work together. If we look at the first statement we reviewed, we see the income statement. Now, I've colored a few of the accounts here so that we can see how they flow to some of the other financial statements. So the first thing we want to look at is net income and other comprehensive income down here. So net income is going to flow into my statement of changes in equity here. So here's our net income line, and you can see that it's the same amount that was on the income statement. Similarly, the other comprehensive income line also showed up on our combined statement of income and comprehensive income. This statement then flows into our balance sheet. If we look at the beginning balances here for equity and the ending balances here for equity, we'll see all of those accounts showing up in the balance sheet down here. So notice that every account that started shows up in green as part of 20X1, and every account as it ended shows up in blue as part of 20X2. Let's come back now to the income statement and look at a couple of additional numbers. Remember that gain on sale of equipment and the loss on sale of securities? Remember those, and let's look at that net income number one more time, because all three of those flow into the operating section of the cash flow statement when we use the indirect method. Again, we're going to look here at these balance sheet figures and go back to our balance sheet. Remember, these are the changes in the operating assets and liabilities on our balance sheet. So let's go look at the balance sheet and see how those changes come through. Finally, the last thing we want to look at is this cash value. So the beginning and ending balances in cash reconcile to the beginning and ending balances in cash on our cash flow statement. So now that we've seen how all of these financial statements fit together, isn't it beautiful? When this works together really well, we know we've done it right. Let's take a moment to review some of the things we've talked about. First, we talked about the cash flow statement. Specifically, the operating section has a choice of two methods, the direct method and the indirect method. Remember that most companies use the indirect method, which begins with net income and then reconciles to cash flow from operations by adjusting for non-cash expenses and the changes in the operating assets and liabilities of the company. Then we talked about additional disclosures that are required when the indirect method is used. Remember, cash paid for interest and taxes is required to be disclosed. The financial statements relate to each other in many different accounts, not just retained earnings as most people think. And remember that when we have a full set of fully articulating financial statements, it really is a beautiful thing.